and it's time for another Macro Monday, where I get you ready for the week ahead in 5 minutes or less. As always, this is just a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage on the week ahead, I will include a link to our full edition in the description of this video. And if you enjoy these videos, I highly suggest you check out our full newsletter. Okay, as always, we are going to start with our chart of the week. And here we are looking at capacity utilization against the unemployment rate. So Tuesday's industrial production report will update capacity utilization trends. And that's a series that has consistently led movements in the unemployment rate over the past few decades. The data could either support the case for further upside in unemployment or suggest that a peak is near. Either way, the outcome carries direct implications for the Fed's path in the coming quarters. Why are we focused on this? Well, as you'll see on the next slide, we have the FOMC meeting where the Fed is expected to cut rates almost 100% at this chance coming up on Wednesday. And the Fed is leaning heavily on weakening payrolls and softer job openings to justify this almost certain policy adjustment. So anything that tends to lead labor market series like the unemployment rate is something we are going to be paying close attention to. This is especially true given that inflation still sits above the Fed's current target. So onto our calendar. The third week of the month usually gives us a first read on conditions, and this is true here. So today we'll see the September Empire Index from the New York Fed, followed by the Philly Fed on Thursday. And then Tuesday delivers a trio of coincident indicators, some we mentioned on our chart. We have retail sales, industrial production, and capacity utilization. These are useful for gauging current GDP, but less effective as leading indicators. However, a more forward-looking indicator is the NAHB Housing Market Index, which is also out on Tuesday. Housing stocks have rallied over the past 3 months on the prospects of lower rates and a cyclical recovery. That's not to say that fundamentals have dramatically improved for buyers, but there are expectations that housing conditions, while still currently weak, have potentially trod for the cycle. Consensus for the NAHB data point is 33, which speaks to ongoing issues with affordability and a lackluster new construction. And then, as I mentioned, the FOMC meeting is on Wednesday. We highly expect a cut, and the S&P 500 continues to climb on that expectation of a more accommodative monetary policy. The Fed's rate decision arrives this Wednesday, as I mentioned, and a cut of at least 25 bips is effectively guaranteed. Markets will parse the chairman's remarks for guidance on how aggressive the path of easing will be into year end. As of Friday, the odds have crept up for 3 consecutive cuts. That currently stands at 50%. Recall that in 2024, the Fed cut rates by 100 bips, even with a strong labor market and inflation above target, although it was down from its cyclical peak, if you remember, after COVID. The lagged effects of that stimulus are now only filtering through to leading indicators, which has fueled equity strength and the relative outperformance of cyclical sectors in the recent months. So we have some leading indicators up this week, and then all eyes will be Wednesday when everyone expects that we will finally see that first rate cut. And that's what I'll leave you here today. I hope you all have a great week. Don't forget to subscribe, and I will see you right back here next week for another Macro Monday. Thanks for watching.